Hello, traders. It is June 17th, Wednesday evening, and that must mean that it's time for the weekly swing trading video. We've had quite an exciting week since last week. Wanted to show you a pop-up right here. This is a bulletin that I posted. All of the weekly swing trading videos are posted on Option Stalker along with my pre-open market comments. And you can see here that on June 12th, I did send a special notification. I also sent an email with this video link, and we were able to enter a trade selling the Netflix June 26 400 puts, buying the 395 puts for a credit of $1. So we do still have that trade on. Reason I mention it is because if you recall, a week ago I'd mentioned that this upward sloping channel, the upper end of it had been breached, and that we were perilously close to a market pullback because we had a bullish climax. That's exactly what happened. This is when I did the video right here on June 10th. Look what happened the next day. We had this gigantic gap down, and then the S&P 500 sold off 100 points. I did cancel all the trades that we had out for that week, but I did do a follow-up video. I did want to get that Netflix spread off because I felt that this is going to be a good opportunity for us to get into the spread. But after such a huge drop like this, I didn't know if we were going to test 395. I was waiting for that support to form. Unfortunately, when it did happen, it happened in one day, and that was Monday. You can see the open here below the 200-day moving average. Got down to about SPY 297. Didn't make it down to the 100-day moving average. Didn't make it down to SPY 295, which I consider this 294, 295 level on the SPY to be major support. So as long as that's intact, I'm okay selling out of the money bullish put spreads. Should that fail, the character of the market has changed. I think we need to be very careful and let the market come in and find its next support level. So for this week, you can see 1, 2, 3 tests of that 200-day moving average. Monday was the key. We opened on the low and we rallied the entire day to close near the high of the day. Then yesterday, Tuesday, we had this unbelievable gap higher. I believe it was about a 70-point S&P gap higher. It might have even been 80 or 90 points. And I had mentioned to everyone in my morning comments before the open, I said, listen, folks, we are going to have a chance to sell bullish put spreads. You do not have to panic into this trade. There's going to be time. So let's take a quick look at the price action on Tuesday, and we can see how that early gap higher started to fade and fade and fade until we eventually filled in the entire gap that was created. And there's the opening gap higher on Tuesday. And you can see that we came all the way from SPY 307 and we opened up at SPY 375, so that's an 80-point move. Market kind of tried to challenge that high a little bit, but we had the 10P indicator spiking, and we knew that we were in trouble because of that big spike. I can put that up just so that you can see what was happening on the 10P indicator, and that was a sign for concern. Then I kind of knew that we were going to be into some trouble early on. You can see that big spike right here. And then we had that upward sloping trend line on an M5 basis fail. So the market came all the way back and it almost filled that gap. I believe we're about 30 cents away on the SPY from filling it. And then we got a nice decent bounce, floated right into the middle of the trading range for the day. So not a bad rebound at all, but it did kind of take the wind out of our sails as far as being able to do any kind of bullish put spreads, because we had that big market reversal on Monday. Then we get this massive gap higher on Tuesday. There's no way I could have gotten the trades out fast enough for you. So right now we're going to be kind of evaluating. I've got lots and lots of bullish put spreads that we're going to try and put on this week, but we're going to do it at our price. And that means that out of the 7 new bullish put spreads that I'm going to show you, maybe we get filled on 2 of them. We're not going to get filled on all of them. We're going to need some help from the stock. We're going to need some help from the market. I think we're going to get a little bit of help from the market, because if you look at the price action today, it was not off to the races today. We had a nice little open, and then the market kind of spent most of its time in a trading range, but we saw late day selling. Late day selling is a little bit of a warning sign, especially after we've come off of those recent highs and after we've tested the 200-day moving average 3 times. So it tells me that there is still some persistent selling pressure out there. And you can see how most of the day the market didn't do a whole lot. There was the high of the day. We challenged the high from yesterday. We pulled back, gave it one shot towards the late part of the trading session, and then we faded down to the low of the day, closing on the low. S&P 500 futures are down 6 points right now. The way that I would characterize this market, and you've heard me talk about this before, is that the Fed is pumping money into the financial system, and this is happening across the globe. Central banks are printing money like mad, stimulus programs like mad to get the economies back on their feet again. So asset managers, I believe, have a mentality where it's recovery or bust. They're all in. They're perfectly fine being in the market because they can't generate any decent returns in the bond market. Bond yields are producing negative real returns. So what's the risk? The risk is that I go into the marketplace, I buy equities, I'm long the market. There I can at least try and generate some reasonable rate of return if the market does go higher and if this recovery does take root. And what's my downside? If the recovery stalls out and the recovery is not happening, I can count on the Fed for additional monetary stimulus and for perhaps a $1 trillion infrastructure bill. That's what President Trump's talking about right now. Perhaps it's going to be another $1 trillion small business stimulus plan. They are going to throw the kitchen sink at this problem. And so asset managers see this as a no risk situation. If the recovery stalls, coronavirus is starting to increase again as economies open, the number of new cases is growing. President Trump said there is no way we're shutting the economy down again. We're just going to have to deal with it. We're going to have to practice social distancing. We're going to have to wear our face masks, but we are not shutting this economy down. So asset managers, they're happy being in stocks. They're happy being in the market where they can at least generate some type of return. So those are the forces that are coming into play right now. We've got earnings season will probably kick off in about 3-4 weeks. So typically stocks tend to be pretty strong into earnings season. There's a bid that grows. A lot of the big tech giants, Apple, Microsoft, Amazon, Facebook, on and on and on, those really big tech giants, they actually benefited from the coronavirus. So they comprise about 20%, 25% of the S&P 500. So the QQQ has been off the charts strong. Let's put that up. That's where we want to be. We want to be in tech stocks. You can see the prior high. You can see how the QQQ got through the all-time high and made a new all-time high. We know the S&P 500 is nowhere near the prior all-time high, but QQQ, that's where the leadership is. Those are the stocks that we want to focus on. You can see how during that market pullback last week, we ducked right below that breakout, but boom, got right back above it and right back on track. So my philosophy is follow the money. Asset managers are happy being in tech stocks. I'm happy being in tech stocks. Economy starts to struggle. We can count on the Fed. We can count on the government for fiscal stimulus. And the stocks that we're going to be in should do fine. So that's our game plan. Now I'm going to get into the individual stocks that we're going to be trading. We don't want to lunge. We don't want to force trades right now. We're in the summer doldrums, and the market is still trying to find its way. So what we're going to be doing is we're obviously leaning on that 200-day moving average on the SPY, but I'm really counting on that 295 level where the 100-day moving average comes into play and that horizontal support level is. That's the one that I really want to see preserved. And the nice thing is that we can gauge how these tech stocks did during this market pullback last week. And if I look at a tech stock and I look at the low that it put in last week, I can assume that that low is pretty much going to be preserved because that's right where the 100-day moving average comes into play. So before we get going, let's take a look at some of our open positions that we had. I took a screenshot of all of our open positions in the staged order entry screen. And you can see here that we had a number of trades, and I made a mistake. This Netflix trade is the one that we were able to get off last week. We were able to sell the Netflix June 26 400 put and buy the 395 put for a $1 credit. So this was the special alert that I sent out with the video link that I mentioned at the beginning of this video. That is marked in yellow, which means that we canceled the trade, but that's not actually true. This is the one that I needed to cancel, and that was our original order that I put out last Wednesday night. So this trade right here is actually still alive, and we've got that on for another week and 2 days. But these trades are all canceled, so you won't see them in the staged order entry screen. I sent out a special alert Thursday morning. I said, don't do these trades. We've got a huge market decline. All of them actually would have done very well. If you look at Nvidia, Microsoft, Apple, and Netflix. All of these we would have been filled on at really good prices, incidentally, and they would be in great shape right now. But I didn't want to take that risk because I didn't know how far the market would fall. And again, it was on that coronavirus news that it was starting to spread again. I knew that bullish speculators were going to get flushed out. I thought we'd have another day or two to at least try and get the trades out. I had considered doing a video Monday night, but the snapback rally Monday was so severe that I'm just going to wait for the Wednesday video and see how things are playing out. So, AXP last week, boy, that one gave us some fits. We had that stock pulling back and pulling back, but Friday it actually rebounded and it finished out of the money, so we were fine on it. But I gave you instructions last Wednesday evening. I said, try and buy that AXP spread back for 19 cents. That we put it on for 20 cents, so we made a whopping penny on the trade. But more importantly, we avoided a loss. We dodged a bullet. We had this Netflix trade on, the 390 puts and the 385 puts. That was toast. It was way out of the money. This PXD spread was way out of the money. That expired, no problem. These were each 25% winners. This one you basically scratched on, but I'm going to count it as a winner because I want to keep the streak alive. Haven't had a losing trade since the middle of November when we closed that Disney put spread down. We closed it down probably 2 hours after we put it on for a small loss. So I want to keep that streak alive. And we've got one more position on right now, which is LVGO. And there we are short the June 19th $50 puts, long the $45 puts. This thing is toast. I believe the stock closed at $65, so we're about 15 points out of the money with 2 days left. That was a super, super nice trade because on that 5-point spread, we got $1.15 credit. So I think that's going to come in close to a 30% return on that trade. Really, really nice. So let's go in and let's take a look at how the current staged order screen looks. So I'm going to click trade and I'm going to click staged. And here you can see LVGO, that's one position that we currently have on. That spread is 5 cents bid, offered at 10 cents. Don't buy it back in at this stage, just let it expire worthless. And there's the Netflix trade that I'd mentioned. Short the 400 puts, long the 395 puts. Did that for $1 credit. Beautiful trade. 10-cent bid, offered at 27 cents. We put that on for $1. This is likely a week from now going to be a 25% winner for us. So let's take a look at Netflix. I love Netflix. In fact, we're going to try and do another Netflix trade this week. Well, why the heck do you like it so much, Pete? I think this is a flight to safety stock now. I really do. Netflix has had so many subscribers join. Everybody's watching movies. If they can't go out and socialize, they're staying home and they're watching movies. Netflix has been able to add lots and lots of subscribers. I know that there's a lot of competition right now with lots of streaming video coming out, but years ago, Netflix decided that their point of distinction was going to be their content. So they've spent a lot of money developing their own original content. You can only get it through Netflix. So I know I'm a Netflix subscriber. I like a lot of the shows that they put out, so my loyalty is there. I think that's pretty generally true. And it's only a $12 a month fee, so it's not very expensive. I think Netflix continues to do really well. And when you've got something like that that's working, and you can see that Netflix has not gone parabolic like a lot of other stocks have, and we can still get some decent credit and let it kind of move around, I love it. So we are going to be doing a Netflix spread this week, but you can see how during that big market drop last week, Netflix really held its own. Look at this. It barely even budged. That's when I knew I wanted to do that trade. I wanted to get it on as soon as possible. And this was the sell-off Friday. That's what it did Monday when the market made a new low down to SPY 297. Stock didn't even move. Love it. When you see that type of strength, you know you've got a good one. 1, 2, 3. Lots of support coming right into play here. So let's take a look at the new Netflix trade that I want to put on. And yes, we're going to double up on Netflix if we can. And you can see here that I've got a Netflix July 405 put and a July 400 put that I'm looking to sell with the July 10 expiration. We want to get $1 credit for that. So let's take a little closer look at that. Sorry about these bulletins here. And we'll pull up the option chain for that. And again, we're looking to sell the Netflix. Those are the July 10s. And the reason I selected July 10 was because we've got a holiday in there. And that means that we're going to see some pretty slow trading. It's going to be the dog days of summer. Absolutely. So we're selling the 405 put. And go into the July 10 expiration on that. Go into the right stock. First of all, looking at Netflix, going into the July 10s. And there we're looking to sell the 405 puts. And we're looking to buy the 400 puts. You know that there's a $5 difference in the strike prices, so we're looking to get $1 for that spread. And you can see that that spread is 20 cents bid offered at $1.45. Can we get $1 for it right now? Probably not. We're going to need some help from the stock. It's going to have to pull back. I think that the market was a little soft going into the close today. I didn't like the way that the market closed today. So it's possible that we see a little bit of selling tomorrow. So yes, we want in every single instance, we do not want to go banging trades out here. We want to let the market come into us. We want to be firm on our price. If we get filled, we get filled. Wonderful. If not, we'll take a pass. We'll keep trying. So that's the first spread that I'm going to show you. Selling the Netflix July 405 put, buying the July 10 400 put, doing that trade for a $1 credit. Next, we'll go into the next spread here, and we're going to CRWD. All right, so on CRWD, we're looking to sell the July 2nd. So we'll go a little bit closer in time, the 84 put, and we're going to be buying the 83 put. And you know that we're going to be trying to do that for a 20-cent credit. So let's go in, put in, actually, let's do this. I'm going to put in the symbol, and as I do that, my option chain is going to update. So we're going to be looking at CRWD, and that stock has been super strong. I'm going to take off this 1OP indicator to make it a little bit easier for us to see the chart, because then I can expand the actual chart view. Look at that beautiful sloping trend line. 45-degree angle. Nice, perfect. We've got this earnings announcement just recently, so we know that the reaction to that earnings announcement was excellent. The stock was able to maintain that gap right there. That is support right there. So you've got a nice breakout to a new high. Stock checks that support 1, 2, 3 times. It's held that 92 level. Wonderful. So I feel that we can actually go down to this 84 level right here, which was that prior breakout right in there. Let's give the stock some room if it wants to come in on market weakness. So we're going to be looking to sell that 84 put and buy the $83 put. And we'll go out, take a look at the July 2nd expiration, and we're going to scroll down, and we're going to click the 84 put, and we're going to click the 83 put right there, and we're trying to do that for a 20-cent credit. Now, I did try and go out and I looked at the July 10s, and the July 10 options actually were a little funky. So let's do that, and you'll be able to see why I went with the week before expiration. As I start going into the 80s, you'll see that we're missing some strike prices in here, 88, 87, 65. Then it goes from 85 right down to 82, not 82.50. I thought this was kind of strange. I was hoping to see some dollar increments in here, and I really wanted to key on that $84 price point, but I wasn't able to do that. So I could have gone out to the July 10s and looked at something like an 82, 81 bullish put spread. But if I'm able to keep this nice and tight and keep it inside of 2 weeks and 2 days, I'd prefer to do that. I don't want to be out there for very long because I want to constantly evaluate market conditions. I want to constantly be able to roll and select new trades. So that's the reason that I'm trying to keep it 2 weeks, 2.5 weeks out. In some instances, we'll go maybe 3 weeks out. So that's the trade we're looking to do. CRWD, looking to sell the July 2nd $84 put, looking to buy the July 2nd $83 put. Comes into play just before the holiday. So I think things are really going to quiet down that entire week. That bodes well for premium sellers. Hopefully we get a little bit of a market pullback this week and we're able to get that trade off. So CRWD was the next trade. Going to the staged order screen, which by the way, if you've got Option Stalker, it's super easy to enter these trades. All you have to do is connect to your brokerage API, Ameritrade, Tradier, Interactive Brokers. Click submit. That order will be there for one contract. Then you can go in, you can adjust the quantity, and the order will be live. They're all on a GTC basis. We're going to keep each one of these trades live until next week. So, till the video next week. So if you can get filled on any of them, we'll take the fill whenever we can get it. So now we'll take a look at another stock. We've got BYND. That's next on the list. That's the July 2nd expiration. We're going to be looking to sell the 132 puts, and we're going to be buying the 131 puts, and we're going to be trying to do that for a 20-cent credit. So let's put BYND in here. We'll move this off screen momentarily so that we can do our stock analysis. So what's so good about BYND? I like this breakout right here through horizontal resistance, and I like that support right there. You can see that even during the big market decline, that horizontal breakout was able to hold. Now, there are probably going to be some pork shortages nationwide because of the pork plant shutdowns due to coronavirus. The notion is that that could really bode well for BYND. People are going to be substituting in their product, and perhaps they really like it and continue to use it longer term. I like the price action. That's mainly what I look at. I look at this upward sloping trend line that's intact, stayed intact during the market pullback. I like it. So we want to try and stay below this horizontal support level right here. Comes into play somewhere around 139. Well, we're actually going to go down and try and sneak inside of it and use that 132 level right in here. That should be even better support for us. So let's bring up the option chain, bring that back into play. We're going to be looking at the July 2nd expiration. This stock also has really pretty decent option implied volatility. So go down, take a look at the 131, 130 bullish put spread. You can see that it is 52 cents bid, which is actually a negative 52 cents because the option bid ask spreads are so dang wide on these, and offered at 58 cents. Well, we want to get a 20-cent credit for that. So we've got a $1 difference between the strike prices. We know if we get a 20-cent credit for that, that we're going to be generating a 25% return on that trade if it works out for us. Take a quick look at BYND. You can see I mean, this stock moves around. You can see that by the long tails above and below body. Look at the resistance forming in here. Tail above body, tail above body. Let's take a look at the price action today. Early in the day, it was off to the races. Look at this beautiful gap higher by BYND. Rally, rally, rally. And then as the market started to soften, actually even before the market started to pull back, you could see some of the selling pressure in BYND, and it just kind of drifted lower the entire day. But different picture on a daily basis. This all looks good. We've got a series of higher lows. We've got this uptrend line intact. We could see that it had relative strength during the market decline. I like all of those, and that's why I selected BYND. So let's take a look at another trade. I told you I was going to load you up this week. I don't know if we'll get any of these trades done, but we're sure going to try. Netflix we already covered, so now we're going to be looking at PayPal, and we're going to be going out to the July 10 expiration, and we're going to be selling the July 10 139 puts, and we're going to be buying the 138 puts, and we're going to do that for a 20-cent credit. So we'll go into the order entry screen. We'll put in PayPal. And these are the July 10s. Again, we had to go out further in time so that we could get that credit. Let's go into the chart, take a look at why we like that. So in all of these instances, if you're relatively new to option stalker and to one option and the way that we trade, we're really looking for momentum. This is a directional trade. We want to see relative strength in the stock. We want to see lots of technical support levels that we can lean on for these spreads. When those technical support levels are violated, we know that we are wrong. And that's where we need to shut the trade down. So in this particular instance, if I start taking a look at what that line in the sand would be, that is my line in the sand. 1, 2, 3 tests of that support at $140. If that $140 support fails, then we know that we need to buy that spread back in. Well, we're actually selling the 139 put, so we're even a little bit below that support. So we'll let it come down and test like that, just bounce off of it. But we don't really want to see it below that because then we'll be filling in the gap. You'll also see that this nice upward sloping trend line is intact as well. PayPal, super, super strong. Now, they are payment processing companies, so they don't have any kind of bad debt exposure. They are exposed to consumer spending, so hopefully that will continue, but the stock really, really looks good. Boy, if we can get this spread off, I feel very confident that that 139 price point is going to be supported. And for that reason, we've got to go out to July 10. I don't mind July 2nd, July 10. We've got the holiday in there. Things are really going to slow down. I suspect that that'll be just before earnings season starts. So there should be a good bid to the market, even if the market pulls back. I think these spreads are going to be in great shape. I just hope that we can get some of them off. So 139, selling that, 138, buying that. And we're trying to get a 20-cent credit for that because there's $1 between the strike prices. And you can see that that spread is 5-cent bid, actually negative 5-cent bid, offered at 17 cents. We need some help from PayPal. It's got to come back maybe into this 156 level. That's where I think we've got a shot at getting filled on it. So need a little help from it, but I really like the setup. Love this a lot, and I love that big support level right in there. So that's another trade that I would consider doing. Again, you'll notice we're having the market come to us. We're not out there chasing. We want to let it come in, come in, come in, and then if we get filled at those very favorable prices, we'll take it. So the next trade that's up is the PINS. Those are the July 2nd $20 puts. We're going to be selling those, and we're going to be buying the 1950s. There's 50 cents between the strike prices, so you know we're going to be trying to get a dime for that trade. And for those of you who think a dime is nothing, you don't have to put up as much margin. So a dime is a really nice return because you have to put up 40 cents on that trade. You make a dime. That's still a 25% return. If you're Trading these days, you should have close to zero commission. So if you're doing a boatload of contracts, it doesn't matter. You're still going to make that 25% return. So I'm going to put in PINS, another internet firm, and we go to the July 2nd expiration on this one. And before we take a look at the trade, I'll just highlight it right here. Looking to sell the July 20 puts, and we're looking to buy the 1950 puts. So we're going to do that for a dime credit. Again, selling the PINS July 20 puts, buying the PINS July 2nd, 1950 puts, and we're doing that for a 10-cent credit. So let's take a look at PINS. Why do I like that stock? Mind you, everything with the exception of BYND is a tech stock. I really like the tech sector. I want to lean on that strength. So PINS, you can see how it broke out through this horizontal resistance level. You can see how that 200-day moving average is coming into play at $21. We're going to go below that. This is as low as the stock got during that big market decline. And so we're going to lean on that $20 price point. So my thinking here is that if the market pulls back and it tests SPY 295, the stock should not drop more than that $20 price point. You can also see that there's the 100-day moving average at $19. That also should be lending support because we're pretty close to it. We're only $1 apart from it. And you can see these long tails under body. This stock looks to me like it wants to break out. It wants to go higher. So they will have that working in our favor also. If that stock breaks through this horizontal resistance, you'll see it float higher very gradually. That also would work in our favor. So we're way down here at the $20 strike price. Again, we're selling the $20 puts, buying the 1950s, doing that for a 10-cent credit, and that is the July 2nd expiration. Going to staged order screen. Only two more left for you here, so we are getting to the end of our list. The next one on the list is ETSY. We traded that earlier this year with good success. There again, we're looking at that July 2nd expiration. Try and take advantage of very slow holiday trading. We're going to be looking to sell the $75 put on ETSY. We're going to be buying the $74 put. Because we've got $1 between the strike prices, we're looking to bring in a 20-cent credit on it. So let's load her up and let's see what she looks like. I am going to spend a little bit of time on how I found these. And you can see that July 2nd expiration right there. And we've got the $75 puts that we're going to be selling right there. And we're going to be buying the $74 puts. You can see that that spread is a negative 10-cent bid offered at 35 cents. Well, we're going to be trying to do that for a 20-cent credit. Not quite there. We need the stock to pull back, but I think that's a really nice one. So let's take a look at the stock. I'll reiterate this trade. ETSY selling the July 2nd. We're going to be selling the $75 puts. We're going to be buying the July 2nd $74 puts. We're doing that for a credit of 20 cents. So I'll move that off screen. Let's take a look at ETSY. See what's so great about that stock. You've got this stock. This is almost a cup and handle formation. You can see it visually right here. Almost gets back to that resistance level. And then there's your handle right there. Now we're trying to break out to a new all-time high. This is what's particularly interesting to me is that the stock did not even take out that low when the market fell last week, and it absolutely preserved this support level way down in here. So I think that that $75 support level right here is going to hold. That was the previous low right in there. We've also got this upward sloping trend line that we can lean on as well. You can click on GTC, click that one or that one. There's your upward sloping trend line. If it's violated, you're going to know about it. And that really is what I would be watching. We want to make sure that that line is preserved. Obviously, we want to make sure that that $75 support level is preserved because that is our short strike price. The stock doesn't do a whole lot, doesn't move a lot. It's kind of like eBay. I had considered eBay, by the way. I really like this formation here. And this is something that you're able to kind of take a look at and maybe decide if you want to do a trade on your own. The premiums weren't there. premiums were horrible because eBay makes such tiny, tiny, tiny moves. Doesn't do a whole lot. So, because there's not a lot of volatility in it, I had to go too close to the money to get a decent credit on it. But if I were going to do a trade, I would look at that $46 level right in here to be preserved. And maybe you could sell a $46 put and buy a $45 put, do that for a 20-cent credit. I think that's a decent looking trade, but the credits are just not there right now. And if something nasty happened to the market, we're too close to the money on this, and any kind of little whiff and the stock could pull back. I also didn't like this series of lower highs right now. So the stock is continuing to probe for support and search for support. It did find it this week, but eBay was not quite as strong a play as I liked. I did like Etsy better, but I thought I would show that to you because it was in the running for a trade. So we're going to go back to the staged screen, and spot is another one that I really like. So on spot, we're looking to sell the July 2nd 175 puts, and we're looking to buy the 172.50s, and we're looking to do that for a 50-cent credit. So let's go in, take a look at that. Move this off. Well, actually, let's just load her up first. And we'll click the July 2nd expiration. And if you're trading using Option Stalker and you want to sell an option, you click on the bid, just like that. And you click on the ask for the one that you want to buy. You'll see the spread reflected. You'll see the bid ask of that spread right there. And in this case, you can see that it is a negative 10-cent bid offered at 60 cents. Well, we've got 2.5 points between the strike prices, so we want to get a 50-cent credit for that. And that's your trade. So again, selling the SPOT July 2nd 175 put, buying the SPOT July 2nd 172.50 put. There's $2.5 between the strike prices, so we're trying to get a 50-cent credit on that trade. And you'll see it right there in the staged order entry screen. How many trades do we have here for this week? 1, 2, 3, 4, 5, 6, 7. Lots of opportunities. Now, we need help on every single one of them. We're going to get filled on 7 trades? Probably not. We're probably going to get filled on 2 of them, though. And if I could do 2 new spreads right now, always want to have something working. Trust me, when the market comes in and I have a very high level of confidence, I'm going to really fire. And the next time that we see that, I'm thinking it might be in September. We're probably going to be buying some call spreads because I think everything lines up from a premium standpoint. Option implied volatilities have been super, super high. So this has not been a buyer's market. For those of you who only know how to buy options, and that's all I want to do, Pete, is I want to buy options. I want to buy calls and I want to buy puts. Forget about it. Would you like to go golfing with one club? You want to go golfing with a putter? I don't know what you're going to do in the tee box. You've got to know how to sell spreads. And like your putter in golf, selling credit spreads is probably what I do 80% of the time. Buying options is extremely, extremely difficult. You have everything working against you, and you're just going to have to take my word for it. Very rarely does the market set up and do stocks set up for good option premium buying. Now, you will see me do options in the last hour of trading on a Friday. That's when I do my lotto plays because option implied volatilities are finally starting to come in. Let's bring up the VXX. You can see that we had a little bit of a spike in option implied volatilities during that market decline recently, but they're still elevated. They haven't pulled back much. You can see where they were. Back in here, when we were buying premium on these lotto trades for months and months and months, oh my God, it was fantastic. In the last hour of trading, we were doing really well with it. But we still have relatively elevated option implied volatility. So as the market continues to find its legs right here, as it continues to compress, you're going to see these option implied volatilities continue to decline. So as a premium buyer, you've got that working against you. You also have time decay working against you. Those are 2 things that make selling out of the money bullish put spreads so dang effective right now. Plus, we can distance ourselves from the action and we can let time decay work its magic while the market is chopping around like this. So don't be a premium buyer right now. When it's time to buy premium, if you're on board with me and you see these weekly swing trading videos, there's going to be a time when we're going to be buying premium. It's not now. So we've got lots of bullish put spreads that we're trying to put on. We've got 7 new trades we're going to try and put on. These will all be active until the video next week. And I hope when I record next week, I'm going to have maybe 2 or 3 of these filled. So we'll be way out of the money on some really strong stocks. It'll probably have meant that the market has come in a little bit on us. That's fine. I had mentioned to you last week that somebody was going to hit the panic button when we would have the potential to get filled, because all we had seen to that point was that the market was overextended on the buy side. And I told you I'm going to have my help chat going absolutely bonkers with people panicking, going, oh my God, should we do the spread? Should we do the spread? I'm so worried. I'm so worried. It ended up being me who pulled the plug on everything. So I just thought it was the prudent thing to do. We're going to let the dust settle a little bit. We'll see how the S&P opens tomorrow. But let me go in and show you how I found some of these stocks. If you're new to Option Stalker, by all means, you should be going in and you should be using the custom search engine. The option liquidity rating is fantastic. I like to use a setting of 2 or higher. Now, this is going to filter out a lot of candidates. If the options are not super liquid, the stock will never show up in the searches. And so that's an excellent search criteria to use. Strength versus SPY, you can go in and mark the daily, the 4-hour, the 2-hour, trade signal strong, you can mark those. That's an excellent search to run. On a day like today, you could put stock greater than prior day high. The market was down today. Any stock that would meet this criteria today is going to be super, super strong. Look at that list. There's not 50 stocks in that list. There's about 15 stocks that you have to knock through and look at. I did look at W. That looked great. NVAX is one that I think there's a really good bullish put spread on that I showed in the chat room today, but that is a volatile stock. Only good for day traders because you got to watch that like mad. And we were selling an out of the money put spread that should expire on Friday. Netflix, there you go. MTCH looked good today. LRCX is breaking out. ETSY is there. I think that's how I found this one. CLX is back on the screen again. Bleachmaker, really good if coronavirus is starting to pop its head up again. CHGG looked good. ATVI looked excellent. ATVI is actually one that looked really good. It's a choppy stock. I love this horizontal support line right in here, but the stock is getting back up to the high. Yes, people will be playing video games if they can't go out and socialize. I need to have that stock pull back, though, before I can sell that bullish put spread, and I'd be looking to key off of that $68 support level. Really good, but it doesn't have a lot of premium because the stock doesn't go anywhere. So up here, I'd have to sell a bullish put spread in here. Not with this stock chopping around. I got to wait for it to pull back. So what might I do in that instance? Well, if I were anxious to sell a bullish put spread on it, I'd click GTC. I'd pick a nice candle that I can key off of. Now I've got a horizontal alert line right there. If the stock pulls back, breaches that, I'm going to get a pop-up alert on Option Stalker. What is that going to mean? That's going to mean that I'm in range to be able to sell that $68 bullish put spread. That's how we do it, folks. You got to use the alert lines. They're diagonal alert lines. There are also horizontal alert lines like that. If I wanted to, and I wanted to place a diagonal alert line, that looks like a pretty good low. That looks like a pretty good low. Click that, click that. Now I've got an upward sloping trend line. If this upward sloping trend line is violated, I would also get a pop-up alert. Every time you look at charts, you should be using your alert lines. Took me, a second to put that up there? So these alert lines are going to help you identify trading opportunities. And if you are religious about doing this during the day, as you see really nice price points and charts that you want to get in on, what's going to happen is you're no longer having to search for opportunities. They're going to be delivered to you in the form of pop-up alerts. If you're an end of day user and you like to do your analysis after the market closes, you're going to log into Option Stalker, and boom, boom, boom. You're going to have 5, 6, 7 different alerts perhaps, and they'll all be trading opportunities for you to evaluate. So very, very effective way to find trades. So this is a great search that you can run. I also like looking for ADX. I'm going to take this. I'm going to clear the upper section. I'll clear this. If you're looking for some shorter term trades, what I'd really key off of is heavy volume. And you can use heavy volume today. You can go in and use any of these time parameters here, like a 4-hour heavy volume, good option liquidity, stock above prior day high. Let's see what comes up there. These would all be good candidates for you because you know that they've got heavy volume. Watch for the earnings. KR is an earnings play. I'm going to highlight KR as well because that came up in the chat room. So heavy volume is a really good criteria to use. You can also look for ADX. Now, if you're using this as a swing trader, the shortest term ADX that you'll be able to use is a 2-hour time frame. If you're a Option Stalker Pro user, you'll be able to use that on shorter time frames, and this is how I find a lot of my lotto plays, is I like to key off of ADX on shorter term time frames, like a 5-minute, 15-minute, 30-minute. Show me those stocks that have a really bullish ADX and that have heavy volume for the day and that have good option liquidity. Oh yeah, deadly, deadly combo. Look at this. These are the stocks that might be of interest to you. Shop has actually been really, really good. I like that one. Double click on Shop, and there is your chart. You can see how it's pressing up against this all-time high, really wanting to break out. Well, how would I approach this one? There, I'd need to sell a bullish put spread below that $700 price point right there. Put the order out there for one contract. You can certainly do that, and you can have a good chance of getting filled on it. Or if you don't want to get filled on it, you don't want to place a bunch of trades out there as a marker, you can find a spot. Just click GTC, and I'm going to double click on that bar right there, and there's my horizontal alert line. If the stock comes in below that 70 to 75 level, then I'll know I've got a pretty good chance of maybe being able to sell that $700 put spread. So in that case, maybe you'd sell a 700, buy a 695, do that for $1 credit. That's how you find it. So lots of criteria that you can use in here. My gosh, as earnings season starts coming up, we're going to be looking for stocks that are going to be announcing earnings within the next 2 weeks. This is a really good search, and it's available on Option Stalker and Option Stalker Pro. Buy into earnings. So somebody in the chat room asked me about this the other day, and they said, "Hey, Pete, what do you think about me buying KR into earnings?" And I believe this is on Monday. And I had to ask, well, how'd you find that stock? Well, it said buy into earnings. And so this company is going to announce this week. So I hover over the E, and that company announces tomorrow. That's Kroger on 6/18. So yes, if you bought the stock or bought some options, the stock was trading around $32. Now it's at $32.81. The reason that this search is relevant is because I've gone back and I've looked at the stocks historically. These stocks, 2 weeks ahead of earnings, have a tendency to rally into the number 75% of the time or more 2 weeks ahead of earnings season, right into that earnings announcement. And so this is statistically significant over the course of the last 3 years. Ideally, I like to sell out of the money bullish put spreads on these stocks. And as earnings season starts to approach, you're going to see this list grow bigger and bigger and bigger. So there'll be more stocks to take a look at. So let's forget for a second that it's Kroger. How would I approach this? Gosh, we've got a nice horizontal support level right here at about the 3150 level. If I can sell a bullish put spread below that 100-day moving average, and I know that the stock likes to rally into earnings, right in here, I can sell that bullish put spread. Stock starts to rally into earnings. Spread expires worthless, which incidentally, we always want to make sure that that spread expires before the earnings announcement. We do not hold over the number. Okay, so another great search that you can use. I think my voice is getting a little bit tired. I've given you a lot of stocks to look at. We got 7 different bullish put spreads to look at. I hope we get filled on 2 or 3 of them. For those of you who are watching this video on YouTube, please go back, take a look at the stocks in each one of the recommendations, see how they've done over the course of the last few days, because I released this video to my members Wednesday evening so that they've got a chance to get in the trade Thursday and Friday. Then I post it to the public on YouTube. You have the benefit of hindsight. You can go back in and take a look at each one of these: CRWD, BYND, Netflix, PayPal, PINS, Etsy, Spot. Take a look at how the stocks have done. If you're a stock trader, I think you'll also find this to be of value because these stocks want to move higher. That's why we're trying to do this spread. So in every instance, we do need a little bit of a pullback. I feel that if the market pulls back, the stocks will hold up well relatively, but they will come in, and that'll give us an opportunity to get those bullish put spreads off. As soon as the market finds its footing, zoom, these stocks are going to go higher, those spreads are going to expire, and we'll keep doing it, we'll keep doing it, we'll keep doing it. If you like this content, please give it a thumbs up. Make sure to subscribe to the YouTube channel. I'm posting videos all the time. Every single one of them has a great trading idea in it and lots of education. Folks, this is how you sell out of the money bullish put spreads. Make sure if you are a YouTube subscriber to turn on your notifications so that you never miss one of these videos. Thanks, everybody. Have a great night. We'll see you in the morning. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.